Fixed income securities. What are they? How safe are they? Can you get paid enough in this market? And when is the best time to invest? First, rather than use my own definition, I went to investinganswers.com and I'm giving you their exact definition. I could not have made it any more concise. They say that a fixed income security is an investment that pays regular income in the form of a coupon payment, interest payment, or preferred dividend. And they give this example. Fixed income securities provide periodic income payments at an interest or dividend rate known in advance by the holder. The most common fixed income securities include treasury bonds, corporate bonds, certificates of deposit, and preferred stock. I would also include a couple of others in that, but we'll get to them later in the show. People who invest in bonds and other fixed income are typically people who want income. For these investors, knowing what they're expecting to receive is a huge benefit. You see, unlike stocks or mutual funds, bonds have two important guarantees. Individual bonds I'm referring to. The first and most obvious is the fixed rate of interest for the term of the bond, which is between now and the time it matures. It means you can depend upon a level, predictable income stream. In previous shows, you've heard me call this a bird in the hand. The second guarantee by the issuer is probably even more important to many income generation members. When a bond reaches its scheduled maturity, you're going to get paid according to the issuer's contractual obligation to you. This is why my firm, for example, puts so much emphasis on creditworthiness and risk assessment, in addition to watching credit ratings and financial ratios. At my company, Sound Income Strategies, we not only look at ratings by the top 3 rating agencies, but we also dig down even deeper and do our own analysis before entering into a transaction. The safest bonds, of course, are U.S. Treasuries. They're backed by the full faith and credit of the U.S. government. In fact, they have the exact same financial banking as the cash that's sitting in your pocket right now. That is backed by the U.S. Treasury, Federal Reserve. They're considered riskless, partly because if they're no good, it also means your U.S. dollars are also no good. The next in the safety spectrum is generally considered with reasonably high safety are municipal bonds. Many of these are backed by the full taxing power of the state, city, or county. These are issuers that don't often go out of business or get repossessed. Although it's rare that a municipal issuer has problems, we still pay close attention to what rating agencies say, and we do our own analysis on any of these that we may want to add in our current client portfolios. In fact, I believe that all advisors using bonds should have chartered financial analysts or CFAs on staff doing further research, digging down and looking under the hood of anything that their clients own, especially in the fixed income world. Corporate bonds are considered next in the risk spectrum. Here is where you really have your 31 flavors or so to deal with. There's a whole scale of credit ratings from 3 different rating agencies, everything from excellent to what's often referred to as junk. These nationally recognized statistical rating organizations evaluate companies based upon the company's ability to pay, the strength of their management, and the ability to raise money in the capital markets, as well as many other factors. The most important guarantee that I mentioned earlier is that at maturity, you are repaid your exact principal amount that you knew and agreed upon when you initially invested. It's important to note that bond funds don't do this. Bond funds don't mature, and therefore, technically, they're not a fixed income instrument. Essentially, they're a legal corporation that contains bonds, but the corporation itself trades as an equity. Because this corporation itself doesn't ever mature, you don't know what to expect to receive, and you give up control over your money. I cannot stress enough that, in my opinion, you should avoid bond mutual funds if you're at or near retirement. You should know that if you own bonds in your portfolio and have an unexpected need to raise cash, you can do so. You can sell a bond before maturity. In fact, investment-grade bonds are very liquid, and they're actively traded on the open market at negotiated prices. The bond market itself is much bigger than the stock market. As we've said on the income generation before, As rates go up, the general rule is that the value of your bond goes down. But does this mean you shouldn't invest in bonds at all right now when rates are at a record low? Well, we'll discuss that in a minute, but keep in mind that for every day that you wait to invest and you have cash sitting on the sidelines, you're earning no or very little interest. And each day that you wait is a day that you're holding on, gambling, hoping and praying that interest rates in the future go up. Why? Because the longer you wait, then you'll need even a higher rate in the future to cover the cost of waiting. Plus, if you're a person who plans to hold these bonds to maturity, as many of our income generation members are, then the price risk, the change in prices when interest rates go up, really shouldn't affect you. And this is no different from an asset like a bank CD. You don't get statements from your bank telling you that your CD is worth a bit less right now because if you sold it early, you'd have to sell it at a loss. They just assume you're going to hold it to maturity. If today's income-based investments accomplish your income needs, then waiting and hoping for higher rates may prove detrimental. There are folks in Japan who are now living with low interest rates for the past 25 years. And a few weeks ago, the Bank of Japan lowered some rates to below zero. So waiting can be risky.